Dear viewers, first of all, I would like to give you a special thanks on behalf of my Banking Knowledge BD channel. So today I would like to talk about the second mechanism or second components of capital budgeting, that is internal rate of return. Okay, so that is the second techniques to find out the project feasibility. So let's get started. So first of all, what is IRR? So IRR refers to the percentage of return on investment. So it refers that it will bring the percentage of return on investment. Okay, so the put in simple, it is the percentage of return of your investment. So how do we calculate IRR, internal rate of return? So if you remember from NPV example, we mentioned that the NPV is dependent on discounted rate. If we increase the discounted rate, the NPV value decreases. If we need to increase or decrease the discount rate to a level where NPV becomes 0, the discounted rate at which NPV becomes 0, in fact, the internal rate of return. In other words, IRR is the opportunity cost at which the NPV becomes 0. Okay, so from the slide, we can say that the IRR means the break-even point where the NPV becomes 0, I mean net present value becomes 0. Okay, so when we increase the discount rate, the NPV value decreases. So we have to increases and decreases the discount rate and trial and error basis to find out the IRR, internal rate of return. So and definitely it will provide you the percentage on investment. So how much you will get the percentage or percentage of benefit from your prospective investment on a specific projects. Okay, that's why IRR is very much important for capital budgeting techniques for identifying the feasibility of a project. So now there is a relation between discounted rate and net present value. So let's say 8% discounted rate, the NPV is 5,000, and let's say at 12% discounted rate, NPV is 0. Okay, and then we increase the percentage of discounted rate by value. 12% is the return we are getting from the projects. We are project, and this 12% is called the IRR. Okay, so what we take the decision from this slide. So we see that at 12% the NPV become 0. Okay, so NPV becomes 0, so that is the position there is neither profit nor loss, so that is called the break-even point. Okay, so where the NPV becomes 0, then that percentage will take into consideration for considering the IRR, that means internal rate of return. So this 12% is called IRR, internal rate of return. Okay, so now there are some important notes. For constant rate of cash inflow for every year, internal rate of return can be calculated with the help of formula. Okay, for uneven rate of cash inflows for every year, IRR can be calculated by little trial and error adjustment. Okay, so when will be uneven rate, then you have to calculate the IRR on trial and error investment in adjustment. So accept the project when IRR discounted rate or opportunity cost of capital, then discounted rate or opportunity cost of capital is greater. Okay, is greater. Then we shall reject the projects when IRR is less than discounted rate or opportunity cost of capital. Many accept the project when IRR equal discounted rate or opportunity cost of capital. Okay, so many of us calculating that when IRR, internal rate of return, and equal discounted rate, that the percentage also calculated sometimes. Okay, now the relationship between IRR and discounted rate and NPV. So if IRR is greater than discounted rate of opportunity cost of capital, then NPV is always positive. If IRR is less than discounted rate of opportunity cost of capital, then NPV is always negative. So if IRR equal discounted rate opportunity cost of capital, the NPV is 0. Okay, so there is a three scenario, three scenarios. There are three scenarios. That is, the NPV is always positive and NPV may be negative NPV, and then the NPV is 0. Okay, so as long as the NPV is positive, the project is financially viable or feasible. The moment that NPV becomes negative, the project is not financially viable. Okay, so always consider that when the NPV is positive, you can choose that projects for investment. So now this is a example. The cost of a project is taka 1000. It has a time horizon 5 years, and the expected wise incremental cash flows are for the first year taka 200, for year 2 that is taka 300, and year 3 taka 300, year 4 taka 400, and year 5 taka 500. So compute IRR of the project is opportunity cost of capital is 12%, and tell us should we accept the project or reject. Okay, so now we have to calculate the IRR at opportunity cost of capital at 12%. So we know that when the NPV is 0 or NPV is positive, then the IRR we can select that IRR. Okay, so now step 1, take K as 12% and calculate the NPV value. Step 2, if NPV is less than 0, then project is not financially viable at 12% discount rate, and then NPV is greater than 0, then the project is financially viable at 12%. However, we need to know the actual IRR value, so we need to increase the K value and calculate NPV, continue it till you reach a point where NPV becomes 0 or close to 0. Okay, step 4, the K value at which NPV becomes 0 or near 0 is the actual IRR or internal rate of return. So there is a math. Okay, so we know that the K value was given at 12%. K, so K percentage on point on 2, and 1 plus K equal 1.12. Okay, so there is NPV formula, cash inflow subtract cash outflow. We know that earlier. So that is cash inflow. If you put this figure to this formula, you will find that there is a figure. This is total cash inflow. There is here, and this cash outflow was 1000. Okay, we just invest the 1000, and just based on this we are calculating this. Okay, so this is net NPV is total cash inflow minus total cash outflow is on 69.18. So here is given that this is the cost of the project is taka 1000, and the time horizon was 5 years, and the incremental cash flows are here. Okay, so now this is NPV is positive, we found that. So what will be the decision? We can accept this project. Okay, accept this project at the discount rate 12%. The NPV is on 69. This is positive, and at discount rate 17.7, the NPV is 0. Therefore the IRR is 17.7. Okay, so since the IRR discount rate, the project can be accepted. That's why so this is finally we can conclude that we found that at 12% the NPV is positive. Then we know that to find out the actual IRR, we just increase the cost of capital rate and trial and error basis, and when the NPV is becomes 0 or close to 0, that should be the actual IRR. Okay, that's why this is 17.7% is the actual IRR. There is a table, you know that in the university level we use that table for calculating this math, or if we increase the trial and error basis, the percentage of K, then by through the scientific calculator you can also done this math. Okay, so finally I think that you have I have clear to you. I have provided you the clear message for calculating the internal rate of return. There's I think you have you are satisfied for my videos today. So if you like my video, please share my video and comments on this, and if and please subscribe my channel, okay, and keep in touch with my channels. That's all for today. Thank you very much.